In this All In podcast, the hosts discuss the successful launch of SpaceX's Starship and its importance for humanity. Antonio Gracias, a SpaceX board member and special guest on the show, highlights that the Starship is a new vehicle, and its successful launch proves that the technology platform is capable of taking humans to Mars. The point at which the vehicle takes maximum stress, called Max Q, was one of the most critical factors in this launch, proving that the vehicle is capable of getting to orbit. It is also noted that building a new vehicle takes time, and it may take at least 2 to 3 months to rebuild the pad and test the new vehicle for stability. Gavin Baker shares some of the metrics that help realize the impact of this new vehicle, including its cost to launch a payload. He notes that the variable cost to send over 100 metric tons to orbit is under $2 million, which is a significant step change and an enormous accomplishment. Antonio mentions that the SpaceX Falcon 9 and Falcon Heavy are the most reliable vehicles on Earth in human history, and this new vehicle is a massive win for the company and the country. The hosts discussed the shift towards AI and the coming implosion of many companies with valuations less than their preference stack, in which the investors get paid back before the common shareholders get anything. This means that the founders and employees of these companies risk losing their equity and are likely to look for new opportunities or start their own companies. The rise of AI has also lowered the amount of capital needed for startups, which means that early-stage investing is becoming more attractive, but investors with large funds will struggle to invest in these smaller startups, which require more hands-on attention. Therefore, some investors may opt for capital as a service, or investing in many smaller companies, rather than a few larger ones. The hosts discuss the complexity of managing and supporting many different companies in multiple countries, which requires sophisticated automation software. The investors acknowledge that the current state of technological advancement and AI poses an investment challenge due to rapid and unpredictable changes. Despite the difficulties, the investors are optimistic about the situation and see great potential for future unicorns in several categories like AI infrastructure, AI co-pilots, and software products enhanced with AI. They discuss the various factors that make this an exciting time for technology startups, such as the absence of competition from big tech companies that cannot currently offer such high salaries or job stability as they once did. They believe that there will be disruptions, but that the overall environment is excellent for investors who are selective and focused on investing in promising startups. The group then discusses a new screenplay writing software called SAC that helps writers develop dialogue and storyboards. The software allows writers to make their writing snappier or more in the style of Quentin Tarantino or Aaron Sorkin. One of the hosts is impressed by the idea and is willing to invest $25,000 in the developer's company. They discuss the funding environment for startups and note that while there's a lot of funding available for early-stage AI startups, funding has dried up for late-stage companies, as seen in the chart showing Series C funding dropping to zero for U.S. companies. The host suggests that valuations for late-stage companies that raised money in 2020 and 2021 are now out of whack, and VCs are reluctant to invest in companies with a restructured cap table. They note that even Tiger Global, the most active late-stage investor, is trying to figure out how much to mark down its portfolio. The group concludes that while there's still dry powder out there, there's no willingness to deploy it. The portion of the transcript discusses the issue of marking the valuation of private assets and how different players in private markets have varying incentives and methods for doing so. The host speaker gives an example of a company where they had invested and how they marked down the valuation by a third based on the evaluations of private equity firms. The host goes on to explain the difference between venture capitalists and private equity firms in terms of their valuation methods, with VCs being more optimistic and focused on buying deep out of the money options, while private equity firms take a more sober approach, mitigating risks and focusing on downside protection. The discussion also touches on some recent events surrounding hedge fund Tiger Global and SoftBank's Vision Fund, as well as the decision of the host's own company not to raise a fund and instead focus on figuring out the real value of their private assets. Despite his past successes, the host expresses a sense of humility and acknowledges that he currently has more questions than answers. They discuss the challenges of raising funds and investing in current times. They are weighing whether to invest large sums of money or small ones, and whether to operate as an incubator or accelerator. They also express concern over the drying up of late-stage financing and mention that they have personal investments in a company that is doing a pay-to-play round. They explain that a pay-to-play round means that investors either have to invest their share of the funding or risk being diluted by 10 to 1. This can be challenging for investors as they may have to put up more money to preserve their ownership in the company. The speaker mentions that the company should have reduced its burn in order to avoid having to do a capital call from existing investors. The speaker also mentions a situation where a company was able to let go of its workforce by moving its work to models. But the founders were able to keep their shares or get re-upped in the process. The host suggests that companies should explore using new AI models and auto GPTs to cut off costs. He expresses frustration with the fact that companies are not aggressively taking these steps and going to investors to pony up more money instead. He suggests that investors need to hold companies accountable and ask questions about what steps the companies have taken to cut costs. The discussion also touches on the topic of pay-to-play situations where the management team gets rebooted and the cap table is wiped out except for those who participate in the new round. The greater fool theory is mentioned, and the conversation highlights the self-fulfilling problem that arises when no one wants to be the last investor to fund a company before it becomes profitable. They mention the belief that only 10-15% of companies have properly reset their value, and the majority of unicorns are zombie corns. The host also mentioned that 70 public companies in technology that have gone public in the last 3 years are trading below the cash that they have burnt, which means that they are currently worth less than the money they've spent. This statistic is based on the retained earnings on the balance sheet of these companies. This contrasts with private markets where they haven't seen a similar write-down or companies being worth less than the cash they've raised. The speakers also discussed the nature of the relationship between founders and VCs. They noted that VCs typically talk about it as a partnership, whereas founders often view the money as a commodity, particularly during up markets. However, during down markets, when it becomes harder to raise money, relationships become more important since founders have to rely on their investors. The hosts also emphasized the importance of trust between the founders and investors, particularly in a low-interest rate environment in which cash is readily available. One host stated that to make it a partnership, he needs to know that the founders have done everything in their power to reduce costs and put the company on the right trajectory before issuing capital calls to investors. The podcast also briefly mentioned breaking news from Stack Overflow and discussed the SEC's Wells notice sent to Brian Armstrong of Coinbase. They speculated on the reasons behind the U.S. regulatory authorities' crackdown on crypto and whether it was a coincidence or part of a broader effort to protect the American dollar. They highlight Coinbase as an example of a company that played by the rules and tried to do everything right, but still struggled to get a license. They contrast this with FTX, a fraudulent crypto company that was able to game the system and gain regulatory approval through large donations. The conversation then shifts to the topic of self-regulation, with the hosts discussing the tobacco industry's failed attempts at self-regulation and the ineffectiveness of smoking and non-smoking sections in public spaces. They argue that good examples of self-regulation can be found in industries that impact everyone, such as aviation safety. The conversation concludes with a brief discussion of political polling updates regarding potential candidates for office. According to a poll from the University of New Hampshire Survey Center, Ron DeSantis, governor of Florida, is the only candidate with a legitimate chance of beating Donald Trump in the Republican primary. Despite a brief surge in popularity when Trump was indicted, DeSantis' lead over Trump has decreased by 10 points in the last 2 weeks, leaving him with a 20-point deficit in the poll. However, the primaries are still a long way off, and the situation is always changing. Sasha suggests that the early stages of the race most closely resemble Hillary Clinton's 2007 campaign against Barack Obama, in which Clinton was the favorite, but Obama eventually came out on top. The primary race does not begin until February, so there is still plenty of time for the tables to turn. Chamath believes that Nikki Haley will be the Republican nominee and that the same culture wars that DeSantis is using to appeal to Republican voters will also appeal to the general electorate. However, this is still a strategy that is most suitable for Republican voters, rather than the electorate at large. The issue at hand is a lack of transparency in Disney's programming, which has created mistrust and unease among some parents who no longer feel comfortable trusting the company's content. The conversation also touches on broader issues related to education in America, specifically the decline in standards and the ideological component that has crept into schools. The hosts agree that every kid in America deserves a high-quality, non-ideological education, and that focusing on this issue can garner support from both Democrats and Republicans. The hosts also mention upcoming meetups for all-in fans and urge attendees to have a great time and share their experiences on Twitter. In this portion, they discuss the economic implications of SpaceX's ability to lift payloads more efficiently and affordably into orbit. They explain that the Falcon 9 rocket can lift 17 metric tons into orbit for a variable cost of around $15 million, which is a 50x reduction in cost compared to previous methods. This change in cost and efficiency has enormous implications for the space industry, including faster transportation, improved logistics, and the ability for entrepreneurs to affordably launch new projects into space. They also discuss the potential for the same design to be used for transport to Mars and the emergence of new markets in the near future. Additionally, they discuss the inspiration and sense of history felt by those present in mission control during the launch. They note that while there were some setbacks along the way, the fact that the launch ultimately succeeded is a great accomplishment for the team. They emphasize the intense sense of focus and excitement surrounding the launch and how one could even feel the ground shaking during liftoff. One of the hosts reflects on his experience visiting SpaceX's starbase and how amazed he was at the engineers' commitment and talent. The hosts also expressed their gratitude for the sacrifices made by Elon Musk and the entire SpaceX team over the past 20 years and highlight the importance of this launch for the future of space exploration. They note that mainstream media coverage of the launch seemed to lack the perspective and excitement that they themselves experienced while witnessing it in person. Starship had 31 engines, each with different tolerances, and had undergone over 1,000 improvements prior to the test flight. Despite exploding during the landing phase, the hosts emphasized the incredible progress and innovation made by SpaceX, particularly through its iterative process. However, they express frustration with the mainstream media's negative portrayal of the event, citing sensationalist headlines and biased reporting. The hosts urge listeners to focus on the success of the rocket's flight and acknowledge the hard work and sacrifice of the SpaceX team. They express admiration for Elon Musk and the company's innovation, believing it to be a source of inspiration for all Americans. In this portion of the All In podcast, the hosts discuss the impact of SpaceX's Starship on Starlink, the company's satellite-based internet service. The Starship is capable of carrying 600 plus satellites, whereas the previous top-of-the-line rocket, the Falcon 9, could only carry around 50. This means that 20 times the number of satellites can be launched at a lower expense. SpaceX has also received permission from the FCC to put up around 12,000 Starlink satellites, which will be a big disruption to the global internet connectivity market. They are advantaging their own solution, putting other existing providers in a difficult situation with no alternative. The host also discussed the growth of SpaceX's Starbase, with JCal taping from one of the little houses lent to him. The enthusiasm of the public towards SpaceX, though not mirrored in the press, is also highlighted. They describe the process of making Starship as extraordinary and how they are constantly iterating and experimenting with things like the tiles on Starship. They also briefly discuss Elon Musk, saying they know him well and that he is doing great stuff in the world. The conversation then shifts to a different topic where they discuss the settlement Fox had to pay for defamation and how they feel about it. They believe that the media is constantly inaccurate and should be held accountable for their actions. They discuss the standard in New York Times versus Sullivan and how it needs to be revised to ensure that media outlets correct their mistakes at the same level as the original story. They also talk about the trick in journalism to bury corrections and how the media should be liable if they refuse to post corrections and publish lies that damage someone's reputation. The group discusses how media outlets often rely on other publications as sources, which creates a problematic echo chamber. They argue that media should have their own fact-checking systems and not rely on other publications to provide protection against liability. Specifically, the conversation centers around Fox's recent $800 million settlement with Smartmatic, a voting machine company. The group posits that this settlement could be the first of many lawsuits against Fox for spreading false information, and that eventually media companies need to be held accountable for publishing the truth. Furthermore, the group argues that fines for certain offenses, such as speeding tickets, should be proportional to one's net worth. They point out that in Finland, for example, a Nokia executive was fined $103,000 for going 45 miles per hour in a 30 miles per hour zone, which is proportional to their wealth. The host suggests that proportional fines could be a way to incentivize big tech and media companies to be more responsible with their actions, knowing that the fines will have a significant impact on their finances. They note that private equity organizations and hedge funds could fund lawsuits against media companies, which could embolden more people to take legal action against these companies. The host suggests that there may have been internal text messages between the hosts of the network that knowingly spread these false claims, which is why they settled for $800 million rather than the full amount of $1.40 or $1.5 billion. However, he also acknowledges that similar allegations about electronic voting machines being hackable or rigged have been made by both sides in the past. The conversation then veers towards the use of AI models and the importance of using accurate and reliable data sets to train them. Reddit, which is a popular online forum where users can post and discuss topics on various subjects, has announced plans to start charging companies that use its data to train AI algorithms. The co-founder of Reddit, Steve Huffman, states that the value of the Reddit corpus of data is incredibly high, and they do not want to give it away for free to some of the largest companies in the world. The group then discusses the need for more fact-checking and less reliance on anonymous sources in the media. They suggest that there should be a clear delineation between what is fact and what is opinion, which would help to rebuild trust in the media. Additionally, they contemplate the limits of free speech and what can or cannot be said without evidence to back it up. The competitiveness in the AI space is evident as Google announces the merger of two organizations that were previously seen as very different from each other, Brain and DeepMind. Chamath shares that he met someone who had replaced a third of their company with an agent within 6 weeks of training it, highlighting how AI is rapidly and significantly changing the way businesses operate. However, the podcast also acknowledges the negative aspects of AI, such as the company that used it to build a library of toxic compounds. As a result, the hosts express their uncertainty about how to approach AI investment and their roles as business leaders. They recognize that the pace of change is so high that it is difficult to determine the right path forward, which may result in investors and companies losing money. Despite this uncertainty, they note that capital will still be allocated and operations will still be run by individuals, highlighting the importance of leadership and individual decision-making. The podcast ends with the recognition that predicting winners and losers in the AI space is harder than ever before, concluding that investing in this phase of technology advancement may generate 10 times the value created during the internet's advancement. Check out the full podcast by clicking the link in the description below. Make sure to like, comment, and subscribe for more content like this. Thank you for watching to this podcast summary episode of the Pod Slice.